I'm going to try and summarize the paper in the shortest way possible. It's really good to be in control of the dollar.
It certainly helps to have your own home currency as the main invoicing currency in world trade, and the dollar happens to be that. So you do get some kind of insulation from exchange rate shocks arising elsewhere, because everybody selling to the U.S. is pricing in dollars, and those dollar prices are not very responsive to exchange rates, both in very short horizons of 1 quarter or all the way up to 8 quarters. The pass-through into the U.S. is quite low.
So international trade prices are sticky. I found this fascinating because we're really used to the idea, or at least the academic discussion, that domestically prices are sticky, which is, for example, why it's so hard for Greece to become competitive. It means giving everybody a pay cut. But it turns out that internationally, in international trade, prices are sticky as well.
That's correct. So if you look at international prices, and I've studied this quite carefully for the U.S., if you look at U.S. import prices, it's about sticky for about 10 months. And if you look at U.S. export prices, it's about sticky for about 12 months. But this goes even beyond the duration of price stickiness, that even when you observe those prices changing, they don't seem to be very sensitive to exchange rates, which is why you can go 2 years out and you can see the pass-through into the U.S. is still quite low.
So when we're talking about currency wars, it seems, reading your paper, that the idea of a currency war is a very simple analysis, because it takes a long time for a devaluation to actually have an effect. But even more important, you have to draw a distinction between which currencies are being devalued. The stronger currency, or rather the more commonly used currencies, like the dollar and the euro and the yen, and the currencies that are not more commonly used in international trade. Is that the right way to think about it?
That's absolutely right. I think there is an important point to note is that when people think about currency wars, they first assume a lot of symmetry in the world. There is a common sense that if your currency depreciates, it makes you more competitive in world markets. It doesn't matter whether you're the U.S. or if you're Turkey or India. But what we need to recognize is that's actually not the case. When the U.S. dollar depreciates, indeed, it does make U.S. exports cheaper on world markets, but it doesn't do the same thing immediately for India or for Turkey, because everything India and Turkey sells is invoiced in dollars, and those dollar prices aren't moving around immediately, which means that for international buyers that are facing these dollar prices, their quantity responses are not going to be big.
So this is really important. It's not possible then to look at the devaluations that have happened in Asia over the course of the last month and say these are competitive devaluations, they're fighting over trade.
Some of it seems highly exaggerated. Like, for instance, the Chinese so-called devaluation of 4% and the impact of that. It has been reported as that being a big move in terms of gaining competitiveness. That's a pretty weak argument. It's certainly true that Chinese import prices will go up in yuan. But in terms of exports, this devaluation for its competitiveness is not a big deal.
Well, let's bring this back to the broader subject of the conference, which is monetary policy. It's often said that Janet Yellen is central banker to the world. So the possibility of this rate hike or tightening over the course of the next year, given your work, what effect is that going to have on the rest of the world?
So the one piece that I can talk about is going to be through the inflation channel. So as the Fed raises interest rates, and that's also happened in anticipation of the interest rate increase, we've had a dollar appreciation. Now, the implications of that appreciation for U.S. inflation itself is quite small. But the implication of that for other countries, like, say, Turkey or Japan, whose currencies are depreciating relative to the dollar, are going to be far more significant. So I think that there is a bit of asymmetry here, which is that the impact on the U.S. itself is not that big, but the impact on other, especially emerging markets, would be fairly strong.